There is a button inside your banking app that is designed to keep you in debt for over 20 years. It's called the minimum payment, and it is one of 6 traps built into your financial life on purpose by people who make money every single day you stay stuck. Today we're walking through all 6, what they cost you, and the calm way out of every single one. This is just my personal research, not financial advice. But trap number 6 is the one almost nobody calls a trap. Most people call it being responsible. Let's get into it. Trap number 1. It's 11 p.m. The sneakers are in your cart. $120. Ouch. But wait, 4 easy payments of $30? That's not a price anymore. That's a rounding error. Click. And that click is the entire business model. Buy now, pay later isn't evil because of the fees. Most plans really are 0 interest if you pay on time. It's designed to do something sneakier, make spending feel smaller than it is. Stack 3 or 4 of these and your next 2 months of paychecks are already spent before they arrive. And roughly 1 in 3 users ends up paying late fees anyway. The product works exactly as intended, just not for you. The Koala rule. If you need 4 payments, you can't afford it yet. And that's okay. Save 2 weeks, buy it whole, feel the real price. Simple. But trap 2 is worse. It's the one from the very beginning, and the math is genuinely disturbing. Trap number 2, the minimum payment. Say you owe $3,000 on a credit card at around 24% interest. That's roughly the average rate right now. You pay only the minimum every month like the app suggests. Ready? 22 years. And you'll hand the bank more in interest than the $3,000 you actually borrowed. And here's the part that should make you a little angry. That minimum number is not there to help you. It's calculated to keep the debt alive as long as legally possible, because your interest is their income. The button is polite. The math is predatory. The fix: pay more than the minimum, any amount. Even $50 extra a month collapses that timeline by years, not months. Quick pause. This channel is brand new, and I'm building it into the calmest place on YouTube to learn about money. No hype, no Lambos, just math. If that's something you want more of, the subscribe button is how you vote for it. Okay, trap 3 is sitting in your driveway. Trap number 3, the brand new car. Not cars, the new car, financed over 6 or 7 years. A new car loses roughly 20% of its value in the first year alone, and about half by year 5. Financed over 72 months, you can genuinely owe more than the car is worth while you're still paying for it. There's a word for that: underwater. The trap is the monthly payment question. The dealer never asks, "Can you afford this car?" They ask, "What monthly payment works for you?" That question is designed to hide the total. The Koala way. Buy a 3 to 5-year-old car, ideally in cash or close to it, and let the first owner eat that depreciation for you. Same road, same radio, half the loss. Trap number 4 hides in plain sight: subscriptions. Quick test, right now, without checking, how much do you pay per month, total? Streaming, cloud storage, apps, the gym you visited in January. Got a number? Studies keep finding people underestimate that number by more than half. The real total is often a car payment, on autopilot. Why does this one work so well? Because each leak is tiny and the pain is silent. No bill in the mail, no decision to make. That's the design. A price you feel once and pay forever. Here's the move. Open your bank app tonight, list every recurring charge, and cancel anything you haven't used in 30 days. Most people find $100 to $200 a month. That's $2,400 a year for one boring evening. Trap number 5, the extended warranty. That moment at the register. Would you like to protect your purchase for just $12.99 a month? Sounds caring. But ask yourself one question. Why is the cashier required to offer it? Because for the store, it's one of the highest profit margin products in the entire building. Higher than the thing you're buying. They're not selling protection, they're selling fear at checkout. Most of these plans are never used or duplicate coverage your credit card and the manufacturer already give you for free. The Koala way. Skip it and drop what it would have cost into your own emergency fund. Congratulations, You just became your own insurance company, and this one actually pays out. And now, trap number 6, the one from the beginning. No fees, no interest, no fine print, and it might quietly cost you more than the other 5 combined. It's the money you keep safe. Here's the trap. Money parked in a checking account earning nothing while prices rise around 3% a year. $10,000 sitting still loses about $300 of buying power every single year. Give it a decade and you're down $2,600 without spending a cent. Nobody stole it. It just evaporated, politely. Now, the honest fine print. You do need cash. An emergency fund of a few months' expenses stays in savings, always. That's your firewall. The trap is everything beyond that. Money you won't touch for 10 plus years belongs where it can grow. For me, that's boring, broad index funds. $100 a month at historical market averages has grown to roughly $226,000 over 30 years. Not a promise, just a very patient machine. So, the final verdict. 6 traps, 1 pattern. Every single one is engineered to feel small, easy, and responsible, while the cost hides in the total. Pay in 4, pay the minimum, pay monthly, pay for protection, park it safely. The escape is the same boring move every time. See the full price, pay yourself first, and let time do the heavy lifting. And be honest with me down in the comments. Which trap got you? Mine was the subscriptions. The Koala was paying for 3 streaming services and watching 1. No judgment here. That's how everyone starts. Thanks for watching. Stay calm, stay invested, and remember, the market rewards patience. The Koala knows. See you in the next one. Your Finance Koala.